Good. So welcome to the Peterson Institute and IMF forum. The topic of the day is a review that the IMF just concluded of the so-called institutional view of, and I quote, the liberalization and the management of capital flows. It's a topic which is quite close to my heart. When I went to the fund in 2008, capital controls, as they were called then, were taboo. I just didn't want them. And then the crisis, the global financial crisis happened, and there were these very large flows. You know, there was Dilma Rousseff talking about tsunamis and so on. And it became clear that position had to be reassessed. And it was a fairly fascinating discussion within the IMF. And I hope one day the historians will actually look at all the documents along the way. But they went from taboo to, the first document said, last line of defense. When everything else has been tried, then just do it, but we don't like it. Then it became kind of primus inter pares. Yeah, you can use it, but you know, there are many other things you should do, like macroprudential tools, FX. And yes, sometimes you can use it. And then slowly it basically became something that was more acceptable. And that was the view which was integrated in the institutional review in 2012. And then since then, so 10 years now, there has been a very large amount of work, both analytical and empirical at the fund, to actually look at all the hypotheses, all the evidence, all the channels for which capital controls and other things affect activity. And this has led to a separate project, although it's closely related, which is the integrated policy framework, which is more analytical and empirical than this review. And then the review of the institutional view with a better definition of the role of what I keep calling capital controls, although they are called CFMs, or capital flow management measures. So that's what we're going to be talking about today. We cannot have chosen a better presenter than Gita Gopinath. Gita has had an amazing career, both as an academic, brilliant and quick, and then decided to move to the fund first as, well, she got a PhD from Princeton. Then she went to Chicago Booth, I think, business school for a few years, then moved to Harvard. And then in 2018, she decided to join the fund as the chief economist, and she was the chief economist until this year. And then this year, she was actually promoted to number 2, first deputy managing director, which has never happened to a chief economist before that. And that's what she's been doing. The nice thing about Gita is that she's been involved in that work for much of her time as a chief economist. So she's really the best person to talk about it and present it and then discuss some of the issues with me. So the plan of today is straightforward. I'm going to let Gita talk for whatever, 10, 15 minutes at the most, just present the main ideas of this review, of the institutional review. Then I'll ask a few questions, and then we'll go to a Q&A. We should have time for that. The way to do Q&A, I understand, is that there's a Q&A box at the bottom, and you can write your questions, and then I will look at the questions and try to ask as many of them as I can, but we'll play it by ears as we go along. So with these introductions, Gita, thank you so much for taking the time after a week, which must have been absolutely exhausting, and we'll listen to you.
Thank you so much. And firstly, thanks to the Peterson Institute for International Economics for having this event, and many thanks to Olivier for sharing this. Olivier has inspired many of us as economists, and frankly, it was when he was as chief economist at the IMF that it made this job also pretty exciting for those of us who were outside the institution. So you've been quite the trailblazer, Olivier. Thank you so much. So let me jump in and do a quick, give you a brief overview of what the new institutional view is, or the update to the institutional views. I want to share my slides for that. Okay, one more click and I'm in full screen mode. Okay, so as Olivier said, there was a period, especially in the 1980s and early 1990s, when the view of the IMF was that there should be full capital account openness, capital flows should move absolutely freely, just like trade, across borders. And then you had the multiple crises in the second half of 1990s, the emerging market crisis, the East Asia crisis, you had the Latin America crisis that also happened around that time. And then you had the global financial crisis, which came later. But you also did have the, the view that capital flows can be disruptive while also being beneficial in other times. And so then there was a change in the IMF view on how to deal with capital flows. And so the original institutional view on capital flow management measures was adopted in 2012 at a time when many emerging and developing economies were dealing with large capital inflow surges. So if you recall, this was the time after the global financial crisis, time of quantitative easing, interest rates very low in the advanced economies, and capital going to emerging and developing economies that were doing much better after the GFC. Now, what was clearly recognized in the IV was that capital flows can bring significant benefits to recipient countries, so that was clearly well recognized. But at the same time, the flows can be volatile. So you can face macro challenges, you can face difficulties with autonomy in your macro policies, you can face financial stability risks that can arise because of this volatility in capital flows. And in this situation, capital flow measures can potentially help address this volatility. And secondly, that capital flow liberalization, while certainly has benefits, it should be well sequenced and planned. So the IV of 2012 focused on managing volatile capital flows. So I'm going to put the emphasis on the word flows. It was about the fact during a period when there was capital inflows coming into countries, and also you had episodes, of course, when capital was flowing out of other countries. Iceland is an example. So question is, how can CFM's capital flow measures help? What they can do is they can reduce the risk that when you have very large inflows, they overwhelm the financial system. They generate a very large credit boom that ultimately can go bust. So they can cause large amount of overheating, and they can also cause your exchange rate to appreciate very strongly. On the other hand, also how capital flow measures can help is that they can limit risks from large outflows in a crisis, and of course, as being part of a broader package of measures to deal with such circumstances. Now, what the IB also made very clear was that the CFMs are only appropriate in limited circumstances and should be temporary. Importantly, they are not a band-aid from poor macro policies. What that means is that if the problem in your country is that you are running fiscal policies that are unsustainable, then what you need to do is use fiscal tools. You need to address that fiscal distortion and not use capital flow measures, because because that's not the right solution to this. Secondly, it's not for influencing your exchange rate for unfair competitive advantage, which means that while you can use it in periods of inflows that are leading to big surges and credit booms and putting pressure on your currency in an upward, in an appreciation direction, it cannot be that the underlying argument, it's not about you influencing your exchange rate to keep it weak for competitiveness purposes. And of course, the ultimate goal of countries is to develop deeper institutions, deeper markets, and then move away from, instruments that can have distorted effects. And so you do want to also consider the long term of side effects when you put in measures in place. Now, what the IB of 2012 didn't focus on was on stock vulnerability. So the focus was on flows, but not on what if you were a country with very high levels of debt already, but you're not receiving, it's not as if you're receiving a capital inflow surge, but your debt is very high. So it's a recognition, and this comes, of course, from a decade of research that has been done, both analytical work, empirical work, inside and outside the fund, that the countries can be vulnerable to flow reversals even without a surge. And this can be true, for instance, if the country has a high stock of unhedged FX debt. Now, let's look at the context today. For instance, we have a point that we made. We've had many countries with very high levels of debt, high record levels of debt in many cases. They don't really have an inflow surge at this point, but that doesn't mean that they are not going to be subject to high stability risks, especially as interest rates start going up around the world. So when you have high stock of unhedged FX debt, that can be a risk. It can lead to flow reversals in the future and currency depreciations that could generate very disruptive balance sheet effects. So this analysis work was also part of the work we did on the integrated policy framework, which is not just about capital flow measures, but looks at the toolkit of if you use capital flow, using monetary policy, capital flow measures, FX interventions, and macroprudential measures. Let's suppose you have that plethora of tools, or you decide to use this plethora of tools. Is there an argument in this environment to still have to use capital flow measures when you have these other instruments also that you can use? And one implication of that research was that indeed you do have grounds for capital flow measures of a particular kind, because you're fixing a problem where borrowers in your country face a private cost of borrowing that is lower than what the social cost of borrowing should be. So there's a pecuniary externality. There's an argument for taxing it. So capital flow measures, which are also macroprudential, may be needed if macroprudential measures alone can't contain risks. So the case for preemptive CFM MPMs, again here, the IMF's Integrated Policy Framework workstream shows that using CFM MPMs preemptively can reduce financial stability risks under certain conditions. The models highlight the vulnerability to reversals from high unhedged FX debt when you have poorly anchored inflation expectations. Well, when you have high unhedged FX debt, because it generates then problems on your balance sheet. If you have poorly anchored inflation expectations, then when your currency depreciates in a very discrete way, then you can set off inflation expectations on a trajectory you don't want it to go on. If you have thin FX markets, if you have dominant currency pricing, which then limits the export boom that you're going to get because of the exchange rate depreciation. So in a set of scenarios, there would be the costs of these reversals in capital flows can be very large. And empirical work also shows you that these capital flow measures can actually rechannel capital flows and make them less risky, right? So there's one thing about what you can do in theory. The question is whether it works in practice, and the empirical evidence does show that at least in changing the composition of the flows, making it less risky, it can work. So this comes down to then the key policy change in this year's IB review is that preemptive CFM MPMs, which is capital flow measures, which are macroprudential in nature, are appropriate under certain conditions. So even if you don't have an inflow surge, but you are sitting on a stock of debt, which is going to be a source of risk, especially if it is FX unhedged debt, then there is an argument to use prudential capital flow measures. This tool can help reduce financial stability risks from high FX debt. Then the question is, does this also apply to local currency debt inflows? And the assessment is that that would be under a much more restricted set of conditions. Why is that? Because when it comes to local currency debt, you remain the lender of last resort in the sense that this is in your own currency. You don't have the balance sheet mismatch issue that comes when you have foreign currency debt. So in some sense, the other macro tools can do a better job and can insulate you more than if it's FX debt. In terms of deploying the preemptive CFM MPMs, important conditions for use are to address elevated financial stability risk associated with FX foreign exchange mismatch. You have to be clear that a capital flow measure, which is macroprudential in nature, is needed to contain the risk, which means that, you know, if there is a macroprudential measure alone which applies to your domestic banking system that's doing the work, then there's no reason to distort it at the border. But if that's not the case, and for instance, you have most of the credit boom that's coming from the non-regulated side of your economy, then you have a better argument for CFM MPMs. And again, like in the original IV, it should not improve, the point of this is not to improve the competitive position when already excessive. Again, consistent with the original IV, you should keep it temporary and targeted as possible to contain financial stability risks. Now, in addition to this main policy change, there were some other policy changes in the IB review where I'll just very quickly mention those. There's a special treatment for some CFMs that are governed by separate international standards. So, you know, the IMF would not assess for appropriateness under IB when the MPMs are imposed in line with the Basel framework, or when you have standards, international cooperation standards against tax avoidance, evasion, and so on. And similarly, and similar treatment for national security measures. So if it's been imposed for national security grounds, we would not judge it, but we would obviously evaluate the impact of those measures, especially if it is a macrocritical on the country and on the rest of the world. So just to conclude, we are a learning institution. The IV is an evolving framework. As we learn more about how to do a better job with dealing with volatile capital flows, the framework will adapt. The most important change in this particular version is allowing for preemptive CFM MPMs, and importantly, taking the, not just thinking about flows and the impact that it can have, but also looking at the stock of debt of a country and therefore giving grounds for why that might lead to certain measures being used. We have a lot of work going on, continues to take place on the IPF work. The IPF is broader than the institutional review because it looks at all these other instruments, not just capital flow measures. We will keep working on that, how to use different tools in an integrated manner, operationalize that work. We will continue to do more quantitative and conceptual modeling work on this front, more focus on capital outflow measures on which there is much less empirical evidence on how well they work or not work, and work on the emerging areas such as digitalization and investigating of spillovers of measures that countries take. So with that, I will stop. Thank you.
Gita, thanks a lot. This was tight, efficient, and clear. Let me start with a few questions. I'll ask first a general one, which was slightly beyond the scope of the review, but I think it's important. I think I have a sense reading the IPF, the Integrated Policy Framework, that there is an emerging view of how to do macro policy in an open, say, emerging economy. So I want to try it on you, and then you tell me, nah, I didn't get it. The problem with the document that underlies your presentation today and the IPF is that there's a lot of ifs and buts, and which is what reality is about, but it's harder to get a clear view of the general picture. So if you don't object, let me try to do that. So I wrote down 6 points. The first one, it seems to me that flexible exchange rates is seen as the preferable way of running an economy, except for smaller, highly integrated countries such as the euro or small countries which really don't have a choice. So flexible exchange rates, one. Second is, once you have flexible exchange rates, inflation targeting is basically the ideal. Now, with the realization that there are many countries where the control of inflation is poor, the banking system is limited, and so on and so on, but basically you try to get there. The third one, which I think follows very much from what you said, is that you want to use macroprudential tools, or MPMs as you call them, to limit domestic risk. And that's whether it comes from inflows, which create domestic risk, or it comes from domestics doing stupid things. So we don't make a sharp difference between the two. Anything which creates risk for the domestic financial system, you use macroprudential tools. The fourth one, which comes very much from your distinction between stocks and flows, is that you're in much better shape if you don't have currency mismatches. So that I infer from this that it would be good to limit currency mismatches, so that issuing debt in your own currency is a good thing, and so on and so on. I wonder whether you have a view as to whether you can go all the way, or in effect there'll always be some mismatch, but that's so. The fifth one is about capital controls or capital flow management. My sense is what you're saying is, yes, there are many circumstances, but basically capital flows with a short horizon are not great, because when they come in, they create chaos, and when they go out, they create another type of chaos, but that's two chaoses for what they do. And therefore, capital controls make a lot of sense. Capital outflow controls are less obvious because they can be, I think, mismanaged more. And there's a sense in which you can tell people you can't come in, but once they have come in, it's kind of unfair to tell them you can't go out. So I think there's an asymmetry, but I would like to know how strong it is. And then the last point is, how does FX intervention fit in all that? And I think my sense is what you're saying is, if you've succeeded in having limited mismatch, you have good macroprudential tools in place, you have capital controls on some of the flows, then things are fine. But if any of these things remain, then you may be exposed to sudden stops or something like this, and then you have to intervene, and then FX can be used in a standard way to basically meet sudden stops or large outflows. So I'm not sure that is the right summary, but as a consumer of the IMF rather than a producer now, my sense is that that's a general picture in which capital controls fit. So let me give you, a few minutes to answer if you have views.
Thanks, Olivier. You certainly make the whole thing more interesting by asking those questions. So I think I'm glad we are getting into all of this. So just to clarify, and you already made this point, but just to clarify it again, that the IV is focused exclusively on capital flow measures, right? So that's what it is. What that also tells you is that we have an institutional view for capital flow measures, but we don't have an institutional view for what exchange rate policy should be and so on, right? Just to clarify that, but you said that, so I'm just re-emphasizing it. Then
why is it that there is no, this is about capital controls or capital flow management. Why isn't there an institutional view on the other things? Or there is, but we're not discussing it. As far as I know, there is not.
No, there isn't. There isn't. So I think the way this came about, Olivier, was that there was, I'd say, fairly good agreement, maybe based on all of our training, on what exchange rate policy should be. So there's a more agreement across the staff on what that policy should be, right? But when it came to capital flow measures, there was less knowledge, therefore less agreement, and therefore very different practices. So I think then they felt like there was a need to come up with a so-called institutional view on that front, right? So coming to the other ones for which we don't have an institutional view, on the first point on flexible exchange rates is preferable. There are benefits to having flexible exchange rates, but in terms of what we would judge as appropriate for a country, it's going to depend. This is related to what you said, but it's going to depend on the country's particular circumstances, right? So if you're a country where, your first 2 points are related because flexible exchange rates and inflation targeting are very closely tied. If you were a country where you have deep financial markets, and you have deep foreign exchange markets, and you have monetary mechanisms that work through the interest rate channel, then in that place, you would be a country that would fit where, you do inflation targeting and have fully flexible exchange rates. But on the other hand, if you were a country where you have multiple financial frictions, you have your shallow FX markets because of which you pay, serious premia on the market to people who lend money to you, then in that case, you can get volatility in your exchange rate, which is not fundamental based, which is based on tantrums and so on. Then in that case, you could have an argument for more of a managed float, where yes, you let the exchange rate move around, but then you intervene in reaction to non-fundamental risks like risk appetite changes and so on. And then there are, of course, countries where the monetary transmission mechanism just doesn't work through interest rates. The only way you can have a nominal anchor is actually the exchange rate itself. And if you're a country that needs that anchor, then the exchange rate plays a role. So it depends upon country-specific circumstances and I was just giving you some more detail about where this is. So it's not as if our advice would be a blanket flexible exchange rates where everybody should be going. On the question of MPMs, so you're right that the basic idea is you want to manage the financial stability risks that are building up in your country, right? Now that can come from multiple sources. It can come, for instance, because the risks are basically at home. You have financial institutions that are doing lending, excessive amount of lending, say to the housing sector, and that's going to create a housing boom, which is then going to go bust. And so then you want macroprudential measures in place. But then sometimes the problem is not that, but the problem is in terms of foreign investors bringing capital in. There are frictions associated with that. There's volatility associated with there. And then in that case, you do want measures. What you need are prudential measures that limit capital inflows, which is then a CFM, right? So it depends upon where you think the distortion is, and that's what it is. Then on your fourth and the fifth point, which is that you're in better shape if you limit currency mismatch and you have lesser short horizon flows. I think, yes, you're right that in general, the bigger source of the problem comes about when you have currency mismatches, which then when your currency depreciates, you have balance sheet problems or short horizon flows because it moves very quickly. The one, of course, only point I would add is that there are several countries that, given the stage of their development, it would be exorbitant for them to issue debt that is in their own currency at long horizon, right? So there is a trade-off. There is a legitimate trade-off, which is they can finance themselves more cheaply given the level of development they're in with foreign currency short horizon flows, right? This is, as we know, how you can get, if you lack commitment, then in that case, you can borrow more cheaply in short horizon flows. So in that particular case, then that is what you have to rely on. And it's forcing the country to move towards long duration debt or moving towards local currency is just going to make the cost of development for them exorbitantly high. But of course, what you then need to do is also have the prudential policies in place and as best possible nudge towards hedging of FX risk by corporations, build up ex ante some amount of foreign exchange reserves so you can deal with that. Then on the last point that you made, which is that FX kind of comes in if you don't have capital flow measures that work well or MPMs that work well. So, Olivier, this is exactly the work that we did in the integrated policy framework, which is exactly to ask these kinds of questions. When you have these four instruments, is it the case that one instrument works much better than the others, and if you have one, you don't need the others? So without going into details, what I can basically tell you is that it is not the case that there is a simple ranking, that if you have CFMs, then you don't need to use FXI, and FXI comes second. There are cases, depending upon what the shock is that you're dealing with, depending on the particular distortion you have in your economy, FX interventions can proceed using capital flow measures, right? But that's the whole IPF work. And I'll stop with that.
This was tremendous. This was a lesson, a lecture in how to think about open economy issues in emerging markets. That you put a lot of flesh and relevant flesh on my bones. Thank you very much. So let me turn to the topic of the day in that context. So I had a few questions. The first one is semantics. I'm sure that there has been long discussions within the fund about the use of the right words, and it's called preemptive as opposed to permanent. And if I were at the fund, I would have argued for permanent. I would have said that basically, and that's something that we should discuss. I don't see much benefits to carry trade flows. People who go in and out just to make money on the interest rate and the exchange rate without caring at all about fundamentals, which is a lot of what the short-term flows are. And so I would have been in favor, and I was in favor, of a toll tax. So you basically pay, 5%. If you stay 3 years, who cares? If you stay 2 days, one cares. And I would have put this as more or less a permanent fixture. In case you actually need short-term liquidity and you have that, and that's an issue, then you use FX. But it seems to me that on net, the kind of carry trade flows are a nuisance. Now, I'm sure you're going to qualify this in 10 ways, but so the question is, why not permanent?
Okay, so to be very clear, what you recognize is absolutely right, that when we are talking about preemptive, the IV and the update to the IV makes very clear that these are temporary measures, as opposed to permanent, which is that just completely never to be discussed again, which already, by the way, makes me a little nervous, right? The fact that I will make a permanent decision is a tough one. But the reason why one doesn't go that extreme, though I completely share your view that there's some kinds of capital flows that have more costs than benefits to them, and there is an argument to intervene. But I think thinking is along the following lines, Olivier, which is one, that many of these countries almost, are in the process of developing deeper markets, of improving their domestic markets, but also improving the kind of financial regulatory structure they have. We know that measures of this kind, which are capital flow measures, which are imposed, are pretty blunt tools. They don't really, if you could perfectly put in a tax that targeted a very specific flow in a very specific way, then that maybe could be done on a much more longer standing basis.
Can I argue that a toll tax, you don't need to know who you're taxing. Anybody with a short horizon will be deterred by a toll tax.
Yeah, so
there might be many issues of people getting around, but in effect, when I worked on it, I thought it's actually fairly hard to actually avoid a toll tax. That does the job. You don't have to know, whether these are good guys or bad guys. They make the decision.
So some kinds of taxes can work. The jury is still out on one's ability to actually control the amount of these flows that can come in, but there is some benefit to it. But the bottom line is that if you are a country, there are many countries in the world that aren't putting these taxes in there because you have financial resilience in your economies. You have the institutions that can absorb these shocks. So when there is some tantrum at the border, there are enough domestic investors that can come in and soak whatever is being sold. So it's not as if all countries in the world regardless of their stage of development, are putting these taxes in, right? So if you are a country that is trying to graduate to a level where you can manage these flows in a better way, then in that case, why make this a permanent tax? The second thing I would say is that sometimes when you need to develop your markets, you actually kind of have to start with the flows that will come. And then that gives you the experience with developing your own markets and then figuring out how to get the better kinds of flows. So I think that's the sense in which this would be temporary. But yeah, I agree with you that there are some kinds of flows that create more trouble than are beneficial. And in that case, one can think of how to regulate them, on a much more ongoing basis.
Okay, I think on this one, let's agree to disagree.
Okay.
And have another Zoom at some stage in the future. The next question is, how different should the CFMs be on the fixed and flexible exchange rates? I mean, you touched on it, but I would like to get a clear view.
Right. No, good question. So, the reason we would argue for using these CFMs preemptively is because we are worried that in the future, you will have a reversal of flows, and then that will lead to massive exchange rate depreciation that can then generate balance sheet issues and so on. And your other instruments that you have in terms of moving your interest rate instruments or any other temporary capital flow measures exposed won't do the job. Now, when you have fixed exchange rates, then you're constraining your policy instruments to how you can react to a shock exposed. And therefore, it's that sense in which if you are in a country which has a fixed exchange rate, for instance, then suppose what's happening is because of an increase in risk aversion in the world, or because the interest rates are going up externally, you're going to have to react to capital outflows with raising interest rates too at the same time, because you have to keep your exchange rate pegged. So basically, you're more constrained in how you can use your policies when you are tied to a fixed exchange rate. What that means is then that ex ante, it gives you more grounds that there would be you would have more arguments for using these preemptive measures.
Thank you. One more, and then I think we'll just open the floor. There has been some discussion, I suspect even within the fund, about whether to use capital flow measures to restrict some kinds of investment by foreign investors, such as real estate. That's a live issue in a number of countries. It's clearly not macro critical, which is one of the criteria that you've set up to justify CFMs. Where does the fund stand on that?
So if you are imposing these taxes on foreign buyers of, say, your domestic the housing market, the real estate market at home, and the reason you're doing that is because you think that activity is building up financial stability risks in your economy, then that would be well within everything we've discussed. So that would be okay. But if on the other hand, you are doing it for the argument that, this is leading to, distribution effects, right? Which is that your own domestic residents aren't able to buy housing because you have the argument is that all these foreign buyers are coming in and bidding up the prices of houses. So if it becomes like an affordability argument, then we are more, we're more skeptical about that. And the reason is because most of the times when you have housing price booms going up, yes, there is some piece that comes from foreign investors buying in your housing market, but it's also often the case because interest rates are too low in your own country, or you don't have good enough macroprudential measures in place that are bidding up housing prices. So we would think of this as you really need to deal with this in using your domestic intervention tools, because that's often the reason why you have unaffordability in housing prices. And of course, also increasing supply of housing and so on. Those are the measures that will be needed. But so that would not be something we would sign up to. But if it was on financial stability grounds or really distorting macro policy making, then yes.
Okay. I think we should probably turn to the questions. There's the large number, which I'm discovering because I was listening to you and now I have to look at them. The first one is about China. So let me just read it. Can continued capital controls by the Chinese government make their planned internationalization of the Chinese yuan renminbi possible? Or will this be an hindrance? I think that's a question about how the capital controls in China fit or do not fit your review position.
Right. So if the question is, Olivier, what I heard was that China is keen on internationalizing the renminbi. Does that conflict with having very strong capital controls, right?
I think so. I think that's a question to which I would add, how do the capital controls in China fit or do not fit the advice that you're giving,
all
which are two different questions in effect.
Yes. So your piece of the question, the answer would be that we have, the institutional review was set up in 2012, and capital controls that are long-standing capital controls that were put in place have been around for well before that time. Is not something that we are going to assess or pass judgment on. It's just grandfathered in, right? To the first question, if you want to be an international currency, you absolutely need to have open capital markets, full convertibility of your exchange rate. So yes, so I think that if a country is aspiring to be a global currency, then in that case you would need to have basically freely mobile capital, full capital account liberalization, full convertibility of the exchange rate, which is not the case right now in China.
So if you want to be a player, you basically have to have no CFMs. Is it what you're saying?
This is what we have seen from history, from the British pound, from the dollar, and that would make sense that if you want to be a global currency, which means that the rest of the world uses it for their transactions in trade and in finance, you would need to have it to be completely open.
Good. Let me move on. There's a question about the state of capital controls as they are in the world today and how this fits or doesn't fit the IMF position. How many countries are doing it right or wrong?
Well, I think, as you know, this is the institutional view and so on is our take on what countries should be doing and our advice. Countries do what they think that, based on their judgment, that is the right thing for them to do. Most countries around the world have used capital measures on a cyclical basis. One of the reasons why we did this whole work on the integrated policy framework was actually just to say that, well, we have a significant number of our membership that use capital measures, FX interventions, along with plain vanilla monetary policy and macroprudential measures. They do it all the time. So in some sense, we were coming to this and saying, okay, they do it, but we just don't have a framework to think about how to use all these instruments. And we have ad nauseum, or rather ad infinitum, we have models of inflation targeting with, when you have deep financial markets, and that's not the issue, but, different kinds of price stickiness and so on in different areas and all of that. So there's a ton of work on that. But for a large number of our members, that's not the relevant question. The relevant question is how to use these different tools that they use anyway in an integrated fashion, which is why we did the work on the integrated policy framework. So your question of how many, I don't know the exact number, but I'm just saying that it's a very common phenomenon for countries to use these tools, far more common than we would think.
Did you discuss these issues with delegations last week? I mean, how many are in line with the institutional view, or how many told you, nah, not yet?
We certainly talked about more than the IV, we talked about the IPF, the Integrated Policy Framework. Countries very much appreciated, on the IV, countries very much appreciated the update, which is the fact that it's not just the flows that matter, but your stock of debt also matters, and therefore you can take preemptive action. So they appreciated that too. I think we're now in the stage, Olivier, where with the integrated policy framework is to kind of think, how do we operationalize all of that, all of the work, which is what we're going to roll out over the next 12 months.
Good, thank you. So there's a question saying it's very difficult to actually know how much of FX debt is unhedged and the net unhedged FX position of a country. So the question is, how much of an issue is it in practice? And if you don't really know, what does this imply for CFMs?
Yeah, certainly that is a very valid question. And we spent much of last year actually putting together databases for countries to be able to make this assessment about how much of debt exposure that they have in foreign currency, how much of hedging that's happening. And you're right, there are limitations, depending on the country, there are limitations on how much information one can gather. I think of this as one of the positives of this is that, when we engage with the authorities, we also point to them that they need to be able to monitor more information on certain variables of which they have no data on. So I think that is progress in that direction. In the interim, we will have to make the best possible assessment given the data that we have, and recognizing that there, of course, that there are limits to it.
Thank you. I keep going down the list. So next one I see is, can you be more specific about the type of capital flow management? I keep saying control, but I should not. Actually, you should tell me why I should not say controls. You will actually be using with respect to portfolio inflows in the form of debt or in the form of equity. What do you actually have in mind?
Yeah, by the way, feel free to use capital controls. It's what I also keeps coming very easily to my tongue. In terms of the specific measures, so yes, so this was again the original 2012 IV. There was a lot that went into what the design of these capital flow measures would be. They take multiple forms. Sometimes they're basically, it would tell, for instance, the banking sector, the amount of restrictions on the amount of FX liabilities that you have relative to your equities, how much, what's the cap on it. You could have a restriction on corporates, which basically, again, tax the amount of, put a tax on how much they can borrow in foreign exchange, which, especially if it is unhedged. There are certain reserve requirements, unremunerated reserve requirements that you can put on the financial system. That's another way of doing it. So yes, I mean, there are details of this. I have colleagues in the building who are much better qualified than I am to know the absolute details of what these exact taxes and tolls look like. But given that countries have been using them, we know that there are several that can be used.
There's a question asking for more information about the IPF. What is it that you did or the fund did, and how did it inform the review? I think you've talked about it, but maybe you can say a bit more.
Yes, so the integrated policy framework is what, it came about because when we have, maybe with the exception of 20 or 30 of our members, for the remaining 150 or plus members, they use not just the standard, interest rate tools, while letting the exchange rate move around flexibility. I mean, that's not the framework they have. They use interest rate policies, they use FX intervention, they use sometimes capital flow measures, they use macroprudential measures. And while we have a lot of work on the kind of how to do macro management in a world where you have deep financial markets, we just have much less for the other countries. So the point of the integrated policy framework was to say, how should a country use these four instruments in an integrated manner, which is that in response to a particular shock and given your country's specific circumstances, how do you use your interest rates, how do you use FX intervention, and so on. So the point of that exercise is, what's good about that exercise is that it nests the pure form, which is that if you are a country where you have anchored inflation expectation, your credibility on your monetary policy, you have deep FX markets, you have deep financial markets, then you collapse down to the stranded flexible inflation targeting. But if on the other hand, you have other kinds of frictions, then certain tools have to be used, and you can use them in a coordinated manner, or sometimes you should not use. I mean, one of the outcomes of the integrated policy framework was also that if just because you have all these instruments doesn't mean that you should use them all the time. In some cases, if you have a fundamental shock, you should be responding to it, and you should let it pass through into your economy and not try to work against it. In terms of where we are on that work front, because the a board approved the institutional view update, what that means is that all the instruments that were analyzed in the IPF work are now, in some sense, blessed. And so we are now in the stage of, we're going to work in terms of operationalizing the IPF and how that will then feed into the kind of policy advice we do when we engage with countries.
Thank you. I'm still kind of going, listening to you and looking at the questions. Is a question that you may or may not want to answer, but it's very targeted at you, which is, where do you stand on the dominant currency, invoice currency issue? How essential is it? I mean, I think this is probably asked by somebody who knows your work and your positions, but you've been at the fund for a while. You see this as a major issue, or less? I think that's a way of asking you where you stand on the work that you have done, which has been extremely influential.
So I'm, based on all the evidence and the data that I have studied, and that many other researchers have also done over the last 10 years. In fact, in the most recent, the next version of the Handbook of International Economics has a review chapter on the dominant currency paradigm and covers the body of work in that. I think what's absolutely clear is that in the short term, when you have a country that trades entirely in a dominant currency, which is almost always the dollar, then when you have an exchange rate depreciation, almost all of the adjustment happens through a contraction in imports. Very little happens through an increase in your exports in the short term, right? And you can see all pieces of it play out as you would expect. What that means is that while, yes, you're exporting less in terms of quantities, you certainly have your profits going up. So over time, that can change. But what that means is that when you are thinking about how to insulate your economy from shocks, the insulation that the exchange rate gives you in the short term is limited. It does not give you the export boom that you would have expected in the standard Mundell-Fleming framework, but it works through, you do get the adjustment that happens through a contraction in imports. Then to the question of what exactly does that mean in terms of optimal policy about flexible versus fixed exchange rates. If the only restriction, problem is that the only feature is that you are trading in a dominant currency, then it remains the case that exchange rate flexibility is the best thing for you to follow. Because yes, you don't get the export adjustment, but you do get the import adjustment. So it's still this. But then to that, when you then add a financial friction, which goes in the other direction, where you have financial friction and you have currency mismatch on your balance sheet, so an exchange rate depreciation is costly in terms of balance sheet effects, then because you are trading in a dominant currency and you don't get that much of a kick to your exports, you get a stronger argument for going towards a managed float. So I'm going to just stop with that.
Good. I'm still going through a list. I'll read one. I'm not sure what I would say in answer, but following up on the Chinese yuan renminbi, since it's part of the SDR basket, does the IMF have a timeline on when China needs to completely remove capital flows?
It's a good question, but the answer, as far as I know, is no, that we don't have a timeline in terms of when they should do it. But what is true is that if you want to become a global currency, like I said earlier, that would require more capital account liberalization. I'll stop with that.
Clear. One more. If you're going to argue for a sequencing of capital account liberalization, what are the top 3 measures that you would push and the last 3 things to do? I suspect that the answer is rather complex. And
Yes.
you're probably going to say that it depends very much on what the situation is initially, but I'm asking the question and then you handle it as you can.
Yes, yes,
It's
Olivier.
it's a good question, but it seems very specific to any country. I mean, I think there's a way of asking it, which is, what is the thing that really countries should not be doing, and then the thing that they can do.
That's right. So I can take off from where your sentence started, which is that it depends on the conditions of the country. There is what would be great. What would be great is if you have a country that can get flows that are longer term in maturity, that you borrow in your own currency. Those are all very valuable. You can finance yourself, you can insure yourself, you can invest, and so on. Then there is, of course, what you can actually get, given where your country is in terms of the stage of development, the stage of its institutions. So I think what I would say is, as much as possible, of course, tilt your flows towards the longer term and keep your currency exposure minimized. But at the same time, if you are getting flows of a shorter frequency in foreign currency much more cheaply, and given the stage of development that you have, then you will have to rely on this, which means then you'll have to take precautionary measures on the other side, which is you'll need to put regulatory measures in place. You will need to, you will have to build up some foreign exchange reserves because exposed you might have to intervene. You need to insist on your firms hedging the FX exposure as much as possible. So, I think that's, that's how I would describe where we would like to go towards versus how to deal with it in the transition.
Question for me, triggered by what you just said. Does this work lead to a way of thinking about the appropriate level of reserves and where we stand relative to that? Is it something that the fund has explored in the past, but will explore again in the light of this view? If you have more capital controls, presumably you need less reserves, other things equal. Where do you stand?
No, I mean, it is correct that because these different tools interact, if you are going to rely on one measure, it has implications for how much of foreign exchange reserves you accumulate. But it even goes beyond that, Olivier, because it depends upon the global financial safety net. So if you rely on a flexible credit line, if you have access to a flexible credit line from the IMF, which gives you liquidity in foreign currency and that you can rely on in a bad time, then you don't need to accumulate.
Yeah, but these are quasi reserves. I mean, it's true from an accounting point of view, it makes a difference, but from a point of view of the country, yes, it's everything you can have access to quickly.
Yes, exactly. But there's a difference between you accumulating it yourself, which you then pay the carry cost for it, versus having access to a line, right? Which is different. So I don't have a simple answer for what exactly that would imply in terms of actual how much would be an ideal amount of foreign exchange reserves now in this world relative to, say, your trade exposure, your finance exposure, and so on. I don't have that number, but true, there would be this interaction. Yes.
Good. I think we probably have time for one more question, with apologies to the other questions. I'll read it. What are your views on the use of macroprudential measures to affect the composition rather than the level of the external balance sheet of a country?
Yeah, so that's actually what we call CFM and PMs. That's precisely what that would be, which is a macroprudential measure that basically tilts the borrowing internationally, your international borrowing away from, say, foreign currency to local currency. That would then reduce the mismatches on your balance sheet, that would provide more protection against financial instability. And that would be called what we call in IMF terminology, CFM MPM, which is a capital flow measure, which is a macroprudential measure.
Good. It's time. Gita, you've been great. I think that has been very, very clear and gave people a good sense of where the fund stands on these issues. It was a pleasure to interact with you and disagree at least on one thing, but agree on the rest. Good. Thanks,
Olivier. Always a pleasure.
Goodbye. Good.
Be in conversation with you.